Hello, everybody. Thanks for attending today. My name is Ilan Handelsman, and I am the National Sales Manager of Raintree Financial Solutions. And I'm joined today by Nick Westring and Marcus Cron of Westbow Capital. Gentlemen, thank you so much for being part of this today. This is our first webinar of this series for the 2021. And I'm really delighted to be able to dive in and learn a bit more about your real estate offering. Over to you.
Thanks, Elon. Really appreciate the opportunity to present for everybody. So to everybody on, I'm Nick Westring, and with me here is Marcus Cron. Marcus serves as the investor relations position at Westbow here, and I have the CEO role. And yeah, I guess just we've been really honored to be able to work with Raintree, because I think to a large degree, the integrity that Westbow really seeks to bring to our investors as you know, a core part of who we are is that same integrity that Raintree shows. And I think just in the financial industry, there can be so much activity that kind of makes you shake your head. And I think the ability for Raintree to just really stick to their core values and keeping the investor first super well aligns with how Westbow feels, where we want to make sure that you know, our investors make a dollar before we ever you know, make a dollar. And you know, we're all in business to be able to kind of succeed together, where combined we can do more than we could alone or individually. And that's really the mentality that Westbow has taken. We want to be a long-term part of people's portfolio, where we just consistently year after year deliver, you know, integrity, honesty, and great results as a part of that. So yeah, really pleased to be able to kind of open things up and yeah, share with you our presentation here today.
Awesome. So we're gonna turn off our cameras here, and we're gonna share our screen to walk through our presentation. And the way we're gonna run it here is there's kind of a Q&A chat box there. So if anybody does have questions throughout the presentation here, feel free to pop them in the chat box, ask them there. We can either address them as we're going through the presentation, or we will have a dedicated question and answer period that we'll have at the end of the presentation. So feel free to wait until that time as well. And Elon will do a fantastic job of moderating, as he always does, and we're ready to walk through this here.
He's shameless about interrupting me mid-sentence if he's got a burning question. So you know, he'll be your representative on that. So
all right,
yeah.
So I'll just kick it off here. As noted, this is a private offering with an offering memorandum. This is kind of the high-level details on the offering with Westbow Capital. And yeah, so for any specific details about the offering itself, we do have an offering memorandum that you can look into for all the specific details on this offering. So I'm going to kick it off here a little bit. I'll pass off to Nick in a moment here, but this kind of just summarizes, kind of gives a background of who Westbow is. This is kind of dating back all the way to 1977 when the group was founded. That's actually our founder, Dick Westring, on the left there in the short shorts. But yeah, it just shows the classic nature of how long this group has been around and how it's been operated as a family-owned business. And I'll pass it up to Nick, who's, you know, Dick Westring's son. So family-owned and operated business is really kind of important to the values of how we operate here with a long-term vision.
Yeah, and there's two guys in that picture that are still, you know, working with the company. So, you know, Westbow has also done a great job of I think just building a team and building longevity over time, both on our employees and in our project types. So, yeah, Dick launched the company in 1977. By 1979, he was building and owning his first rentals, and so he's had a really long track record in the real estate business. He originally grew up on a farm and went into the construction business in order to make enough money to purchase his first farm. And that's really where the roots of our group was founded. So we've got Westbow Agriculture, which many of you on the call may be familiar with, because we've raised capital with Raintree on two separate Westbow Agriculture opportunities. And then we've got Westbow Construction Group, which is, you know, again, that initial business that Dick had gone into in order to kind of make his mark on the world. And now we've got Westbow Capital, which is a residential real estate REIT focusing on Western Canadian residential market. And so we're really, really proud of the company that we've built up from, nothing to, we've got over $400 million with assets under management, over 150 employees. And then this Westbow Capital fund is over $70 million worth of assets with 350 rentals, or over 350 rentals. So, the Westbow Group, we're diversified. We have a number of different spots of influence. And, but, I think that those synergies come with a whole bunch of really distinct advantages. So we've got extremely professional management. We've got diversification, both geographically and in product type. So we've got everything from single family homes to apartment buildings in this fund. And we're geographically located from essentially the coast to Winnipeg. So we've got product in Manitoba, Saskatchewan, Alberta, and we'll very shortly be adding some product here in BC. So, and then the other things is pooled investments. By pooling our investments together, buying better assets, buying more assets, lowering our overhead. And the other thing is just tax savings as well. So we are both registered fund eligible, which would be RRSP and TFSA, which I think is, critical in this RRSP season here. We can, avoid paying Justin some of that money that he would otherwise ask for. And so if we can put more pennies in your pocket, that's a good thing. And then the other thing is just our structuring around a limited partnership structure allows for people to be able to move that income that they would be getting at high tax rate and move it to active business income from passive is another big thing that we'll talk about.
And this is something to compare with, for example, going out and trying to do this on your own, where we give all those advantages. Where if you were wanting to invest in real estate, you're a high income earner and you want to go and buy a single family home, well, you don't get a lot of those advantages of being diversified into multiple units, and you're going to have to go and manage it yourself. You might have a day job where you don't understand all the ins and outs of how to manage tenants, and it can become a lot of stress on you. And the taxes that are going to come, you're not going to be optimized, for example, going into something like this. So we try to resolve some of those issues by structuring it in this way to allow for a lot of these different advantages. So specifically the capital or Westbow Capital advantage, we kind of see ourselves as being quite agile, being able to adapt to changes in inefficiencies in the market. So I mean, there's funds out there that are $1 billion plus and just very large. We pride ourselves in being agile. We manage our overhead well. We kind of highlighted all those different aspects of who we are as a company, because we have we can share resources in the office. We can share office space, so we can reduce the amount of expenses that we have on the fund, because there are things that need to be managed to run this fund effectively. We can do it in a way that reduces the overall overhead that we have to charge to the fund. So we're giving a lot of attention from senior management. So I mean, that's everyone from for Nick or Dick going out to the properties, viewing them, knowing exactly what's going on in the portfolio at any given time. They're giving all of that management expertise and dedicating it to the fund so it can perform to its top potential. So and then just having all that experience in the Western Canadian market, we've been in here for 40 years. We understand it. We know the ins and outs. So enables us to make the best decisions and where to buy and how to manage those properties.
Thanks, Marcus. Yeah. So yeah, another big component, we talk about why management. That's a huge component to, I think, the overall success of any investment is who are the people that are making the decisions and running the business. The next component is actually what market you're in. And, we can talk about real estate. Real estate isn't necessarily all created equal. And so we've really focused, and this is based on years of, 40 plus years track record in the real estate business. Westbow has migrated to, predominantly a residential real estate company, because we really, really like how recession-proof the multifamily particularly, because that's where we have the most stats on. They don't really track stats in the single family market, but I think that they represent each other really, really well. So, you can see here rental rates since 06 in Canada have done nothing but climb. So 08, 09 is particularly where, one would look to see, oh, how did rental rates in Canada compare, during a global economic crisis? And, it was untouched. Same thing on vacancy rate, 08, 09, basically a statistical anomaly as far as change is concerned within that period. And so we really, really like that type of performance in the residential market, because again, if you take a 5-year dip where now all of a sudden you don't see the same level of performance like you could have in some of the other sectors of real estate, this just allows for a lot more stability. And then I think even now moving forward, we expect this to be even greater, because with the onset of COVID, there's a lot more working from home. The millennial generation is now the largest, numerical group in the workforce. And, more and more and more of those people are liking to work from home for a couple of days a week and whatnot. And so this is really, I think, fueled the fire of the residential market, where we're needing more square footage per family in order to accommodate, one or both members of the household doing some work from home. So we can see here our pre-COVID numbers, up until March of 2020, we had an average rent collection of 98.5% and a 2.6% vacancy rate. It says post-COVID is probably more like during COVID. We've been able to up our average rent collection by 99 to 99.3%. And this just really goes to show how well our team has been performing under these COVID conditions. When things happened early on, our property management teams were extremely responsive, right away going to people in the buildings, calming their fears, making sure that they knew that this was a safe place to be. How could they safely pay? All that kind of stuff, making sure that people knew and felt comfortable. This here shows our average vacancy rate of climbing from 2.6 to 4%. That's mostly due to the fact that we bought an asset in July of 2020 that had a 10% vacancy rate, and it increased our average overall vacancy rate throughout there. Had we corrected for that, we would have actually been down from the pre-COVID portfolio, apples to apples, would be down by, I think, almost 1%, or like 0.9%. So you can see here, this is our portfolio. Our Windsor property portfolio is 144 units. We purchased it in April of 2019. It came to us at a 5.5% vacancy rate. By May, we had dropped it to 5%. And this is just showing the graph of it steadily declining. And this just speaks to, the actual Edmonton market has had a few challenges over the last year, some oil sensitivity and things like that. And our management style has been able to both increase the amount of income that we've gotten. We've started charging for parking. We've started charging for storage lockers. So we've been able to increase the overall net income and decrease vacancy, simultaneously, which is a big job for our property management team. But again, speaks to the caliber of salesmanship and organization that they've been able to do. And we can see here as well, if you look at, February, March, April, we had 0% vacancy in that building, just because, again, that property management team was so on top of, there's people who had given their notice and then decided not to move, again, because of how great our property management team was making sure that people felt safe in the building. And we did have some people move out, but we were able to do showings and fill those spots, to a point where we actually raised rents. And that's what caused the spike in vacancy kind of through May there, where we were able to actually kind of increase our overall net income.
And all those things to really highlight is the fact, like on a multifamily property, the main thing that the way they're valued is through a cap rate. And we're just going to highlight that a little bit, where you can increase the value by increasing the income or decreasing the expenses. And, as we kind of showed there, by decreasing the vacancy, that allows more rent to be collected, and also adding that parking revenue and storage revenue, that adds dollars to the bottom line, right? And the way multifamily properties are valued is on a cap rate basis. So every dollar you add to net operating income, let's say for this example, on approximately a 5 cap, which is kind of average for that market, that adds 20 times multiple of that net operating income. So any dollar you add results in $20 in value added to the property. So by adding those, optimizing the efficiency of a property like that, adding income, decreasing expenses, all, extrapolates to large value adds when you look to dispose of property. So I think that's important to highlight. So a little bit about the tax treatment that we see as a big advantage to this structure. We have a trust and we have a limited partnership. Trust is where all the RSPs, TFSAs, and registered accounts go. But the unique aspect is you can actually directly invest into the limited partnership, where all distributions are treated as return of capital, and the limited partnership actually generates active business income. So that can be taxed much more favorably than passive income, which can be taxed depending on the province that you're in, upwards of 50% or over for the tax rate, whereas active business income is taxed at your active rate, which can be 27% or lower. So really tax advantageous for somebody that's looking to reduce their taxes payable on their investments, such as somebody that's, an accredited investor or somebody with a holding company. That's the structure that you really get to benefit from, because, these being large multifamily properties, there's large depreciation expenses that we take on the property that actually reduces the amount of taxes that are paid on those distributions. So, and then on exit, it becomes a capital gain, which is also treated quite tax favorably. So just on our strategies, we've got a couple different strategies on how we're acquiring our properties. One of them we like to highlight is, specific advantage to the Westbow group is because we have a construction company, Westbow Construction, that we call the design build synergy, where construction would go build the property, new purpose built rentals. We vend it into the fund, Westbow Capital. And because we're, saving on a lot of holding costs, marketing fees, and realtor commissions, we can then essentially buy it into the fund at below what it would sell for on the open market. So that discount that we're essentially getting becomes instant equity increase when we make that acquisition. So unique strategy there. The next one is newer acquisitions, simply buying newer properties from third parties. That's, for example, that one out in the Edmonton market where, built in 2015, it's a good property, stabilized, but we just saw some opportunities to increase income or decrease the vacancy rate and just manage it more effectively. The last one is kind of the value add play, where it's the buy and renovate, where it's maybe a little bit old or outdated, still performing well from a cash flow basis, but we look to leverage our expertise in renovations, construction, and then go in, increase rents by doing some renovations and add value to the property.
Cool. Well, maybe I'll kind of run through a bit of how we deploy those strategies in our actual portfolio. So we've talked a lot about the Windsor property. That's 144 units we bought in April. We bought 18 units in Lethbridge, Alberta, in September. This was a bit of a different play. We pre-bought these from the builder. That builder then gave us a very good discount because he was able to save real estate commissions, get a pre-purchase on 18 units. And these units are located in a brand new neighborhood that hadn't really been well established yet. Since then, the neighborhood's getting really, really well established. It's built a great name. There's a brand new school in the area. There's a brand new rec center right across the road from a park. So we're really excited about how that property is performing. Then we bought 77 units in Winnipeg. And so this is that buy and renovate play. So this property has extremely good bones, built in the 1960s though, and was owned for a very, very long time by a single owner who invested almost nothing in the property. So it needed, fairly extensive renovations. We see tons of opportunity in that. So we've been going through and renovating suite by suite on as units become vacant. And so we do a $5,000 per suite renovation. That allows us then to add $1,700 a month in rent to the unit, and that
$1,700 per year.
Sorry, per year. Thank you, Marcus. 17 month.
That'd be a good
really,
return. Yeah,
really, really good return. Yeah. So yeah, then $1,700 a year, which essentially pays back the cost of that reno in 3 years. And then you've also got that additional income. So, we're also redoing a bunch of the roofs, redoing the boilers, and all of these investments that we're making on a rental return basis, we're able to get our money back within a 3 to 5 year period. So it's extremely lucrative for us to be able to do these very specific and targeted renovations to these properties. So far we've been able to raise rents. And so I guess the significance, again, going back to Marcus's cap rate, comment, if I add $1,700 a year in revenue on a cap rate basis, that adds $30,000 worth of value to that building, let's call it. Invest 5,000, get paid back that 5,000 within a 3 year period. And then when you go to sell the building, you get a $30,000 return off of it, plus increased cash flow in the meantime. Is a really, really cool property for us. And the last one is 112 units in Saskatoon. Great location. You can walk out the one side and you're onto a huge park, big neighborhood park. You walk out the other side and you're walking distance to Brown Social House, all the restaurants, all the shopping, Walmart, all that kind of stuff. So really, really great location. It's located in the Stonebridge neighborhood of Saskatoon, which is one of the best neighborhoods in the whole city. Very, very, well located. And just due to kind of the way that we were able to buy this, we're able to drive a 12% cash on cash return out of that building. So again, just a real strong cash on cash return. That's the big thing that we're excited about that. And we'll kind of talk a little bit more about, what exactly we're shooting for as far as returns. So there's 4 main ways that we're targeting returns. First is equity increases. That's that Westbow synergy. So either we're building something and vending it in below market, so there's instant equity there, or much like the Windsor the Winnipeg property, where we're doing these renovations and adding, say, $30,000 worth of value per unit due to our ability to, kind of utilize our construction skills. Second one is debt reduction. We've got mortgages on every property. Renter pays the rent, which pays the mortgage. So that's, pretty standard. Third is positive cash flows. And this is the piece that we put the most emphasis on our particular fund, because we are really, really convinced that over the next 10 to 15 years, positive cash flow buildings are going to drive the real estate market in a way that they haven't in the past 15 years. And that's mostly due to asset appreciation. Over the past, say, 60 years of North American real estate, the average appreciation rate has been just over 6% North American wide. The 15-year average appreciation in Canada is just over 6%. The 10-year is just over 6%. So, it's pretty safe to say, well, the appreciation rate on real estate is 6%. There'll be lots of evidence to back that up. What we're thinking is that, well, just because it's been 6% doesn't necessarily mean that it will be 6% in the future. And so what we've done is, instead of assuming 6%, we've assumed a 1.5% appreciation rate moving forward. We think that that's conservative. We think it could be potentially, higher than that, particularly because of the quantitative easing and cost of capital and a number of those factors that continue to drive inflation, really, of real estate. So, but again, we feel like if there's cash flow, your appreciation will naturally be there, and if there's no appreciation, then your cash flow is still giving you a very strong return. So we're able to give, if you're to invest right now, basically it's like a 5.85, I think it is, percent annualized return on a cash flow basis. And we're targeting a 9 to 12% total return. Again, that's a very conservative number based on historic appreciation. So we've tried to, over the last, number of years, just make sure that we're conservative in our approach, conservative and careful in our management of funds, keep really low overhead, buy great buildings, and keep that train going. So we'll open it up to any questions now. If anybody has things that they want to ask, our skilled and good-looking moderator will will push those through directly to us. So, oh, you're muted there, Elon.
Gentlemen, thank you very much. Yes, I have a good list of questions here. I just want to start off with the cap rate conversation. Not everybody's familiar with how cap rates work and what cap rate means. And in particular, I think that this, you alluded to the fact that people can go out and buy their own real estate, but what you do is you do this all day long, every day of the week, is managing real estate and being able to, make these tweaks in how you manage each property with your eye on the cap rate game for the end result, I think is critical and is something that your regular, DIY real estate investor might not quite understand. So can you just explain to everybody how the cap rates work, where you get to the 5% on that Winnipeg example, and how you're able to drive that return?
Yeah, I'd love to do that. So cap rate, is a short term for capitalization rate, which essentially means that if you take the net operating income, so, gross income minus operating expenses of a particular building, over the purchase price or current market value, depending on how you're calculating it. At this point in our fund, we're calculating it over purchase price. So you're essentially, if you can make $500,000 a year and income after expenses, you're going to take that 500,000, put it over top of a $10 million asset purchase, and you've got yourself a 5% cap rate. So if you can then make that, if you can move that net income from 500,000 to 600,000, you've now just multiplied that. So yes, you're making an extra 100,000 per year, but somebody else will pay you 20 times that 100,000 for the right to own that building, because they can mortgage that building and, it helps them make the payments and they're expecting some appreciation and all that kind of stuff. Right. And so for the same reason that when we go out and we're buying buildings, we're buying it on a cap rate basis. We evaluate how the building's performing. Is there opportunities for us to increase the performance and all that kind of stuff? But as a general rule, depending on the market, they're going to trade within maybe a 0.5% cap rate differential. So, here in BC, your cap rate's going to range from high 3s to low 4% cap rates. In the Alberta market, you're going to range from, high 4s to low 5 cap rates. Winnipeg market's going to be slightly lower than, say, the Edmonton market, but same basic trading range, maybe like 25 or 0.25% lower kind of thing. So essentially what we're doing always is thinking about, when we sell this building, what will another investor look at when they look at our books? And so really what we're doing is we're going through and it's like, oh, this gravel is costing, or say this grassy area here is costing us, $23,000 a year to maintain. If we switch that grass to gravel and made it kind of a hardscape area, it would look nicer in the immediate term because our customers would be happier. B, we're going to eliminate $23,000 worth of overhead expense per year for, say, $40,000 worth of cost. That's wins all the time. And so there's lots and lots of examples as we kind of go through the buildings where we're getting kind of 2 or 3 year payback on the investments, these capital investments that we're making, right? So example, Windsor building, we go through and we've, painted all the lines. We've denoted every parking stall with a number on it, clear delineation, closed off areas that were, just kind of having, unorganized parking on it, and then assigned a parking stall to every single unit. And so then there's certain units that have more than one car. Now they're buying a parking stall from us, whereas previous owner was just, letting people park wherever they wanted to, right? And so our tenants are happier because when they show up, they know they've got their spot. They don't have to think very hard. They just pull right in. We're happier because we have actually increased overall net income on the property. And, I think so. And our investors are happier because when we actually take that net income increase and times it by 20, you get a really substantial difference, right? So I think on our Winnipeg property, we increased our rents by $30 a month. And, so if you take 77 times 30, it totaled out to about a $500,000 increase in the total value of the property on a 5% cap rate basis, just because of that one change, right?
And that was pretty low hanging fruit because we bought the property, right? I mean, we bought it from that property owner that, let's call them a mom and pop owner who didn't have the time or expertise or focus on optimizing revenues. They're more, okay, I've got a nice building, it's producing some cash flow, and I'm not going to invest a huge amount of money to try to optimize it.
But a guy that he has like 500 rental units. So it's not like he doesn't know the business, and he's not so it's mom and pop in the sense of how they run the business, but not necessarily small. So
yeah,
really significant. And I mean, also we purchased the property for, $10 million and be able to increase it by 500,000, within, a few minutes of owning it, really.
Well, and that was
a superb move.
And that was simply because they had it below market rents. They just hadn't kept pace with the rental increases. So, they were essentially offering that $30 rent discount, let's call it, to the tenants. And, that's something we didn't even have to do renovations on. It's simply, okay, raise the rents to market average. That'll allow you to get that extra value and extra income in the meantime.
And so I think with COVID, us getting out and actually walking the properties has been a little bit more challenging than, so we haven't been able to be in the Winnipeg market. So we're doing, kind of paying a person that we trust locally to walk through with FaceTime and walk us through the building that way. And so we've been able to innovate, which actually has worked out pretty good. It's probably cheaper than flying out there and spending the time. But one of the big principles that we have is we get out there and we walk the property and we smell the halls and we, listen and, you walk them at different times of day. And we just think through how are we, if I lived here, what would this be? And that mentality drives mostly out of the fact that we've been in the construction business where we build homes, sold them to people. And that business is just a lot more challenging of a business than the rental business, because there's been a less than 3% vacancy rate in the Canadian market over the last 20 years. So, when you have a less than 3% vacancy rate, there's a lot of opportunity for people to get kind of, let's call it lazy in how their management principles kind of apply to the business. A renter doesn't fundamentally want different things than a buyer does. A buyer just has more options, right? Like, when you look at sell-through rates versus vacancy rates, your sell-through rates would be at 12 or 15% on average, 20-year Canadian average, and your vacancy rate is, so those are actually inverted numbers. It's like, there's 85% of homes that are for sale in a given month don't sell, and 3% of homes that are on the rental market on a given month don't get rented out, right? Like, so there's a huge inverse between between those two markets, right? And so we've really kind of always been in the rental business, but again, I think kind of like a lot of other people were, where we didn't tweak it to the degree that it needed to be. So
great. I want to shift subjects a little bit here. The Westbow synergistic plan, where your construction arm is building inventory and then selling it at a discount, you say. How do you, obviously there are conflicts of interest here, Nick. How do you manage these conflicts? How do you make sure that the right price is being placed on those buildings that you own and build, that you're selling into this fund vehicle?
Yeah, so we have, an independent review committee of which, we've got a a very capable and honest guy that is invested in this particular fund and not invested in anything else. You know, so he's invested in this and is, other than that, independent from the Westbow group. So we kind of put a proposal together. We put it to that independent review committee. They have veto power on anything that has a conflict of interest. And, you know, so we put a presentation like we would, you know, and so that particular committee views every single acquisition that we do. So he's very, very familiar with what are the opportunities, what are the challenges, what are, you know, kind of the things that we're really looking at. And so, you know, I think it's a very robust process where, you know, we also verify it by third-party appraisal. And, you know, I think we're, you know, I guess probably 2 weeks away from being able to announce a big deal where we're purchasing some properties from the Westbow group. And I think you're going to be really impressed, like appraised value versus purchase price. You know, we're talking like almost $100,000 differential between those two. So, you know, it's, in that particular case, it's such a slam dunk that you know, it requires very little thinking as to, you know, do I want to buy this house at 100,000 below, you know, independent appraisal, third party, you know, valuation, right? And so, and I mean, you know, so that, you know, is I think really substantial. And so that's what I think, that's some of the value that we bring to the table is really.
Sure. So Nick, why did you start this fund? What was the rationale back in the day when you first approached Raintree with this wanting help to put together a structure?
Yeah, so originally we actually built the fund to help our employees invest. So, you know, the Westbow team has, you know, a very diverse group of people. We've got agriculture workers, we've got accountants, we've got all sorts of people. And in, you know, in my opinion, if you're earning T4 income and not, you know, kind of taking whole advantage of your RSP opportunities, you're really, really missing out on an opportunity to build wealth. And I was kind of trying to work through this with some of our employees, and, you know, was just really unhappy with what the options were that I felt like were out there on, you know, on a longer term period. And, you know, I mean, actually since launching into this and learning a lot more about a bunch of the different offerings that Raintree has, I realized that I was just actually uneducated about where there were opportunities in the market. But, you know, we were looking at like, man, we're able to make all these great returns in real estate. And, you know, there's these people, these poor people that are buying mutual funds for their RSPs that are, you know, turning them negative returns or, you know, 3% per year. And, you know, no wonder it was disheartening for people to try and save. So we really built this thing to try and help our employees and our whole team save for retirement and build up so that, you know, they're not reliant on CPP, you know, when that time comes. So, or old age pension. Right. And so, so that was really the impetus. And then once we figured out what it would all take to actually launch an RSP eligible fund, and the costs associated with that, we decided that it was actually more responsible to open that up to a larger group, and really capitalize on both our relationship that we had from previous deals with Raintree. And so I really am thankful for the Raintree team helping us craft this offering to both meet, I think, our employees' objectives as well as their investors' objectives long term. And so yeah, that was the main driver, the main impetus behind this, where we really wanted, you know, it's a goal of ours to have, you know, if a Westbow employee starts, you know, as a teenager in high school, essentially, and works their way all the way to retirement, by the time they get to retirement, they'd be a millionaire due to just being able to kind of consistently save a little bit and use that, you know, exponential power of, you know, kind of the power of compound interest and whatnot to their advantage. So it's a big piece of who we are. We're passionate about teaching that and promoting that in our own organization. And yeah, same principles apply. Yeah, so.
Super. If you invested $10,000 over 5 years, what do you anticipate the ROI would be? So the investment is targeting a 9 to 12% annual return.
Yep.
Yeah. So you're going to get like kind of a 60% return over, well, let's call it between 50 and 60% return over a 5-year period. So if you put in $10,000, you're going to get back 16,000 or 15,000, kind of depending a little bit on which share class you buy into, which, when did you buy? Like, did you buy when we very first started, or are you buying now, or, so there's a couple of little tweaks, and that's why we've got that 9 to 12%.
And even the distribution factor, right? Because I don't think we even highlighted that yet, but you're able to take out, cash flow directly as those cash distributions paid directly out to you. So, that 5.85%, you could get that paid out to you, every single quarter. That 5.85% is annualized, but it's paid out to you into your bank account. Or if you're, more interested in growth, you want to see that 10,000, be as big as it can in that 5-year time horizon, you could go with the DRIP, or distribution reinvestment option, which essentially just buys new units in the fund whenever a distribution is paid, which is
juices your return overall, because now you're compounding on that, initial investment.
Yeah, absolutely. So I just want to clarify, this is obviously a private investment that has risks, and these are targeted or anticipated returns, and subject to, you guys managing well, on
and
point,
the market,
and the market's doing as we anticipate and hope they're going to do. But please make sure, if you're considering investing in this offering, that you carefully review it with your private wealth advisor from Raintree, and that you review the offering documents carefully before subscribing.
And Elon, there was a couple of questions I saw coming through the chat, but not through the Q&A. I don't know if you saw those ones.
Yep, I'm heading there right now.
Okay.
So how does a limited partnership work? How are investment funds held, and just describe the share process. So I'll let you take the first crack at it, and then I'll pick up from there.
Thanks, Elon. Yeah. So the limited partnership is, it's a legal entity designed, really to help facilitate growth of business in Canada in particular, right? So the way that it works is it's a limited partner. So you are active. You're an actual partner in the company that's doing this active business, but there's this legal protection that's provided to you, and that's the limited part. So you're limited in your actual involvement in the business, and you're limited in your exposure to actual risk. So that's sort of the legal part of what a limited partnership is. The thing that I should note is
I'm sorry, I'm just going to cut you off there. You're limited in your liability. You're not, that doesn't reduce the risk of the investment.
Yes, that's right. Sorry.
If there was a
liability.
Catastrophic accident on one of your buildings and you got sued for $1 billion, that would not flow back through to investors.
Yeah. Thank you for that clarification. Yeah.
You bet.
Yeah. So essentially that's the limited partnership piece. The investment directly into the limited partnership is really designed for people who have other businesses, particularly people who are professionals and they have holding companies that they do investment activity out of. The opportunity for this limited partnership investment to be kind of optimized is when people are worried about the grind down of the small business income rates because of the new rules that the Liberal government put in around passive investments in hold companies. So that whole structuring there is kind of designed for people who are trying to make sure that they keep a high level of active income in their companies and aren't getting kind of subjected to this 52 or 53% tax rate depending on where you're located out of. So I should just note, that opportunity is available for accredited investors only because it's not covered off by the offering memorandum that covers off the trust. So again, if you have questions around that, please talk to your wealth advisor. They'll kind of carefully walk you through all of that.
And in the LP, it's only cash investments available. And for how they're held, you're essentially getting LP units, which there's a share certificate involved with that to kind of indicate how many units you hold. And then for the trust side of things, then you're actually, if you're doing it RSP or TFSA, you're essentially then investing with a trust company that holds those RRSPs or TFSAs in trust, keeps them registered eligible, and then allocates the funds to Westbow Capital, who then deploys them. So there's a few different options of how those units are held, and I'll let Elon, if you want to touch on any more of that.
Yeah, you did an excellent job explaining it. The LP units are direct for accredited investors. If you're planning on investing through a registered plan, then you go, we'll subscribe you through the trust. Please reach out to Raintree. We will make sure that we get in touch with you. We'll have one of our private wealth advisors be in touch, meet with you, help you establish suitability of this investment based on your current financial situation, your goals, objectives, and help you determine whether subscribing through the trust or through the limited partnership channel is best suited for you, if at all. So moving on to the next question, what is the growth plan for the future? And I suppose we could interpret this question in two ways. So the one is, what is the growth plan for this fund over the next sort of 5 years, 7 years of anticipated hold? And then what is the long-term plan? Like, are you actually planning on disposing of and selling these properties, or is your long-term vision to create another vehicle to hold them and to build your assets under management over time?
Yeah, so I think I'll jump in and answer kind of the first question first or the first side of that, so for this particular fund, we're essentially a month and a half away from kind of closing off capital raise. Then that will be the amount of capital we have to deploy. We're going to buy, we're looking at buying a couple more assets to kind of, close up the fund. We're really excited about some of the stuff that is coming up. We've got kind of another renovation of an older type product that we're looking at very, very closely, as well as, as I mentioned, our purpose-built rental piece from Westbow. So, there's a number of pieces that are really exciting that are coming up. So we hope to just kind of, add to the portfolio. Then, there will be a little bit more that happens as we kind of see things in the market materialize. So our Lethbridge properties, probably selling them and trying to kind of like recapitalize that so we can do that type of spin one more time in the length of the fund. And then at the end of the fund, the real objective would be to sell on the open market and get the maximum dollars possible. And really, we think that that's very, very likely what would happen. We sell all the assets and we pay everybody out. That is just because we think that we are, we think that we're pretty good at management of these buildings. And so therefore, there's more opportunity in us going out and buying somebody else's building that's been mismanaged. It's got more upside potential than something that we've now held for 5 years. We've kind of moved through, kind of the best parts of owning that building, where we've, kind of eliminated the poor management pieces. We've capitalized on kind of that initial real big swing up, $1 million in value in the first year. And then everything after that becomes kind of like very incremental or appreciation based. So our current thought is likely we'll be selling almost all the assets or all the assets, and then rebuying new assets that just have new opportunities associated with them. That's very likely the thing. As far as Westbow as a group and the holistic plan, we likely kind of near the mid 2021, we'll be launching a second fund. So this fund will close. We'll buy all the buildings we can with the money we can that we have. Then, you know, we'll probably just take a little bit of a break, and then we'll relaunch again with a new fund. All the same concepts and principles are very, very likely to apply to that. We're just kind of working through the legal process of getting that piece built. And yeah, so that's kind of where we're going. So we hope to be kind of in this business for, you know, the next 40 or 50 years, and just continue to, I think, bring that expertise and that management capacity that we bring to the table, keep bringing it to the real estate market in Western Canada and beyond.
Yeah, and one final point on that, since we didn't specifically note dates, it's kind of been alluded to, like the fact that, hey, this fund is kind of closing out for the offering. We are specifically kind of closing out to new investors at until RSP season is over. So March 1, I believe, is the last day. So that's kind of when we're going to, you know, take investments or subscriptions into the fund. At that point, we'll let the flow of transfer of money kind of come in. We'll kind of see what, you know, we finally raise in that period, and then deploy it all. And then from that period on, that's when that kind of the 5-year period has already started with the operations aspect, where we really look to optimize things. You know, and as a quick note, we didn't actually highlight the fact that we've already kind of upped the distribution. We actually had started off in the first couple of years here of a 50 cent per unit distribution. And that's when we're going out buying properties. We're looking to you know, do a little bit of CapEx, do some renovations, increase income and different things like that, stabilize it. And now we're enabled to do that. And now we're generating better cash flow on the properties. They're stabilized, they're performing well. Now we've actually been able to, because we have more cash coming in, we can pay out a higher distribution, which is this last quarter, about 2 weeks ago, we just started paying out a 60 cent per unit distribution. So, you know, that real emphasis on cash flow is paying dividends on how we're executing our business plan, on how we're paying those out now.
Great, fantastic. So March 1st is going to be the deadline?
Yeah.
Okay,
so
does your OM expire?
You'll have to have talked to your advisor about kind of like what you're, you know, so there's likely, like, there will be a kind of a paperwork period after that. So it's not like if you don't have your share certificate in your hand March 1st, it's not totally done, but because our OM is open for, I think, another month after that. So.
Okay, great. Well, gentlemen, I think that covers off all the questions that have come in. I've really enjoyed hearing you talk about this fund. And I want to thank all of the participants who've attended the call for their time today. And
thank you, Elon, for leading the charge. We appreciate it.
Always a pleasure, Elon.
Awesome.
Thanks again.
Great. Thanks very much, everybody. Have a fantastic day.
See you.
Okay, bye, everyone.